Good morning and welcome to this Wednesday, July 7th, 2021 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I tell you, the big news here recently is just the continuing drop in 10-year Treasury yield. We saw yesterday a pretty big drop to the downside after a little disappointing economic news. And today we're seeing a very similar drop, another 5 or 6 basis points. So that is certainly going to have a lot of professionals thinking about moving back toward many of the aggressive areas of the market where low interest rates can really escalate valuations, especially in an environment where earnings continue to grow rapidly. So that's something to watch for sure. Looking at the futures this morning, right now, Dow Jones futures are down 33, or that was really as of about 10 minutes ago. Dow was down 33, S&P up 3.5 points, NASDAQ up 80. So you can see already just in that shift and the bifurcation with most of the strength going toward NASDAQ stocks, the impact that these lower interest rates are already having. So that's something to keep in mind as you go into today's trading and throughout, not just today and this week, but really throughout the next few weeks as we head toward earnings and maybe even throughout the quarter, if this continues to be the theme with rates falling again. Honestly, I didn't see this one coming. I didn't think that rates were going to go shooting higher, but I did think with some of the inflationary reports we've had out the last couple of months, and then just the general increase in GDP that's expected, I really didn't think we'd see interest rates moving back down below 140, but we closed below 140 yesterday. And let me get the latest here. Yeah, right now we're at 1.31%, which is down 6 more basis points today. So some of the areas that benefited from the yields moving up are not going to do so with the yields dropping. And that's going to include many of the financial areas, especially banks, life insurance companies, asset managers, investment services. I mean, those areas tend to do better when rates are rising and tend to struggle when rates are falling. So that's what I'd be looking for today. A little weakness in the financials. I'd look for more strength in many of the technology names, consumer discretionary communication services, even some of the healthcare, medical equipment, biotechs. Biotechs love the month of July and didn't get off to a great start. So we'll see whether or not this is a group that can help carry the market higher. Let me go ahead and take you over to Earnings Beats. Want to welcome anyone who is new. Whoops, that didn't work out right. Let's try this again. There we go. Anyone who's new, I do want to just point out we do have a free Earnings Beats Digest newsletter, normally published Mondays, Wednesdays, and Fridays, so 3 times a week. This is a completely free subscription, so no credit card required. You can unsubscribe at any time. I really try to make this as educational as possible. There are obviously trading candidates if you so choose, but mostly it's educational and deals with many of the areas that we feel are critical at Earnings Beats. A lot of relative strength discussion, earnings, just different areas of the market leading. And so that's the theme. And then sometimes it's just outright education, just trying to teach folks about things that I've learned over the years. But just sign up for that name, email address, hit that subscribe button. We'll make sure you get set up. Also, we had a free event last night. Many times these events, we, some of them are for our paid members only, but many times we'll have free events that are open to our entire Earnings Beats community. And that community includes this free Earnings Beats Digest newsletter. So being a subscriber here also gets you access to many of the free events that we have. All right, let's move on. First, let's go into the action from Tuesday. The Dow Jones Industrial Average down 209 points, but you can see it went down to its moving averages and did bounce quite a bit. So back up to about the 34.5 level. And overall, I think that we're still in a nice uptrend here in the Dow, but we do need to break through 35,000. S&P 500 lost about 9 points, but similar to the Dow, we saw the big tail. Earlier in the day, we were down a lot more. We came back. And then the relative strength was seen on the NASDAQ, which actually gained ground yesterday, rising 24 points to 14,663, yet another all-time high close, all-time high record close. Mid caps, small caps taking it on the chin, small caps especially down almost 1.5%. I think the overall uptrends remain in play. It's just that money is rotating right now away from those areas. Real estate and utilities led yesterday. I was actually surprised when I saw this morning, because when I was looking yesterday, and I think when I wrote the daily market report, it was real estate and technology. But technology actually slid back to the third spot, a little bit behind the utilities. So two defensive groups led in yesterday's attempted comeback and rally. That's one day. I wouldn't worry about it too much, but it is something that I wouldn't want to see a lot of over the next month or two. I wouldn't want to see the S&P continuing to move up and being led on a regular basis by these two groups. To the downside, energy and materials both struggled. Energy especially down 3.25%. We saw crude oil prices get up to the target level that we talked about when crude oil broke out of an ascending a triangle pattern, a very bullish continuation pattern. That was at $67 a barrel, and it measured to 77. And it didn't, wasn't that long ago we had that breakout. Well, yesterday, West Texas hit 76.95 early in the day before reversing back and finishing down around 73 and change. So that reversal took a toll on energy. You can see the XLE on increasing volume dropped 3.25%. Also, the rising dollar of late, I think, is starting to pressure energy and materials a little bit. You can see materials from a technical perspective. I don't like what's going on right now with materials. I didn't like the group when it was going up. I certainly don't like it right now as it trends lower, failing to get back through the 20-day. As soon as it hits the 20-day, another big down day. I think we've got to be really careful. If you're in material stocks, you want to watch that dollar closely, because if the dollar continues its move to the upside, I think that's really going to put some pressure on materials, especially on a relative basis, relative to all the other sectors. Financials also, you can see getting up to its moving averages, turning back lower. That 10-year treasury yield dropping is not helping this group right now. The last month, we've been under a lot of pressure with treasury yields, really last 3 months, believe it or not. I looked at I'll show you that chart in just a second. But, when I stared at it, I was like, wow, we've been downtrending now for 3 months. But anyhow, financials tend to take a direct hit when the treasury yields are dropping, and that's what we're seeing this morning. So financials, I wouldn't be expecting too much out of this group today. Let's move on to that 10-year treasury yield. So this morning, nothing out really in terms of economic news. Later this afternoon at 2 o'clock, we're going to get the FOMC minutes. So we'll find out a little bit more what happened at the Fed meeting and some of the discussions and so forth. But I don't expect that to be a major mover at 2 o'clock. I think the Fed's pretty transparent when it discusses its policy statement and so forth. And you got so many Fed officials that are out talking all the time. Probably not going to be a whole lot coming out of the minutes that we haven't already heard. So I wouldn't expect too much of an impact at 2 o'clock today. But if take a look at this chart, this is what I was saying. When I look back, I didn't realize, wow, it's been 3 months since we put this double top in at 175. But look at the slow move down. I mean, putting in a lower low, lower high, lower low, lower high, lower low. And I don't know. Now it looks like maybe we're going to go back and test this 120 area where we had a double top before we broke out in February. I just can't fathom the possibility that yields are going to go back down, toward where they were a year ago. I don't know. With economic activity and picking up, I just can't see that happening. But, the market can do anything. I think we need to be prepared for whatever's taking place. Like I said earlier, I was not expecting to see below 140. And here we are 2 days later, 132. So anything's possible, but you do need to understand the ramifications of a declining treasury yield environment and the impact that that has, because we're seeing it in terms of rotation to growth stocks. We're seeing it in some of the weakness recently in the financials. I mean, you can see the financials now down near about a 4-month relative low versus the S&P, and industrials have already broken to that 4-month relative low. So these are two groups that tend to kind of move with the treasury yields. When they're rising, these two groups tend to do pretty well. When they're falling, not so much. So those are a couple of areas just to be careful of while we continue this move to the downside. All right, speaking of sectors, I thought what we'd do here is just quickly go through the sectors, taking a look at their relative performance and where they stand right now versus the S&P 500, because looking at this 10-year treasury yield chart and seeing this move to the downside, I mean, I think at this point it's pretty clear we're downtrending in yields. So I think it's a good idea to see exactly what's going on. Well, over the last 2 months, with the yields moving lower, shouldn't be too much of a surprise. Technology has regained its leadership role and now looks very strong. You've got the weekly relative PPO, which is now turned up above the zero line. So I think this is a really good turnaround and rebound on a relative basis for technology. Technology, I think, looking really good. And we haven't gotten the breakout, so this could still be sideways consolidation that we're in. But I would be very conscious of the rising relative 20-week EMA, because if we pull back and hold that and then move to new highs, I think that's a pretty good signal that you're going to want to be overweight technology. And if you look back when the yields were falling and we went into the pandemic, you can see what happened to these technology stocks on a relative basis. You wanted to be overweight technology. So that seems to be where we're heading right now, although it may just be a little bit early to make that more lengthy, intermediate term call. Consumer discretionary had been under a lot of pressure. It has now since reversed, and it's come during this last month where we've seen the treasury yields really drop. Consumer discretionary picking back up on a relative basis, just climbing above the relative 20-week EMA. We saw that a couple of times back in April, couldn't sustain it, went right back down. So this is what you want to watch for. Are we going to be able to sustain this move through this relative 20, or are we going to turn back to the downside? One positive I see is that when you look at the PPO, the last couple of times it's tried to get back through its trigger line, which is the 9-day moving average of the PPO. It's failed. You can see it failed back in January, February. It failed again in April. Well, it looks like it's a little bit more successful this time. We're actually getting that move back up above. And if you want to see, if you're looking at it and you're questioning, have we crossed or not? One thing that the stock charts provides you right here are the 3 numbers relating to the PPO. The first number, it's in black, so it measures this black line right here, minus 0.794. So that tells you where you are in terms of relative PPO. So we're still below zero. The red line, however, is a little bit lower at minus 0.816. So that tells you the black line is crossed. And then if you're looking at this in green, 0.022, that's the PPO histogram here. That's what that lines up with. And what that is measuring is the distance between the PPO and the trigger line, the 9-day moving average of the PPO. So if you're looking at this, don't want to do the math, you can use this green, the green figure right here, which coincides with this bar. This tells you that you've crossed. If those bars are above the zero line, you've crossed. If they're below there, then you haven't. You can see back here in January, February, we got up close, couldn't quite get through. And you see how the bars show you got really close. All that's doing, all the histogram's doing is measuring the distance between the PPO and its 9-day moving average. So a lot of folks refer to that as the trigger line. You get back up above that moving average, it's generally a good sign. It's at least showing you momentum is heading in the right direction. A lot of times I'm careful about crossing under the zero line. I'm much more interested if it's crossing and we're back above the zero line. Anyhow, a lot of extra information there, but that's consumer discretionary. I see a lot of improvement. The other thing to keep in mind too is consumer discretionary just broke out on its absolute chart. So a lot of times when you're going through periods of consolidation, you'll see the relative strength drop. That's true with stocks. It's true with sectors. It's true with just about anything. If the market's going up and you're in something that's consolidating, it's going to lose relative strength. Doesn't mean it's bad. It's just going to lose relative strength for a period of time. When it breaks out, sometimes it begins to lead again. And we just got this breakout. Amazon up another $25, $30 last time I looked this morning. Pre-market action. That's going to help the XLY. All right, next up, communication services. You know, the interesting part about this area is it seems like it just hasn't mattered whether you're in a period of growth stocks outperforming or value stocks outperforming. During growth outperformance, you know, we were a little choppy, but communication services really went higher. And then after the initial news, the positive vaccine news, early November, took a little bit of a move up, pulled back one time, and then while value stocks were performing well, communication services did well, and it continues to be in a nice uptrend. So this is a group that seems to be weathering all storms right now, which is good news if you're in internet stocks and some of those areas. Industrials. Now, this is one that's taken a hit because of the declining yields. You know, you look at the absolute chart, there's nothing wrong with what's going on in industrials. Industrials took off, were leading for a while, now they're pulling back. And as long as interest rates drop, we're probably going to see that continue. We'll probably see the absolute consolidation and we'll see relative weakness. Looking at financials, very similar, turning lower, still looks fine to me on an absolute basis, but on a relative basis, the group has been giving something up to the S&P 500. And it will likely continue as long as 10-year Treasury yield continues moving lower. Healthcare has been trying to strengthen. It's gotten up through this 20-week EMA a couple of times. We did this again back in January, a couple of times trying to get through, couldn't quite make it, and then went lower. This is now the third time really over the last month and a half. It seems like healthcare is trying to get going. We have broken out recently. I think biotechs, if they have their typical stellar July, that should help the healthcare group as well. But we're still waiting on that relative PPO to turn positive. We haven't seen that since August of last year. Consumer staples, this is defensive area. Make no mistake, the market doesn't care about defense right now, especially consumer staples. Real estate hasn't been bad though. Real estate, which had been trending lower for a while, 2021's been pretty strong. So after we saw a pullback recently, and I had pointed out 60-minute negative divergences, I don't know, maybe 2 or 3 weeks ago on real estate, and we did pull back after that. Seems like it's trying to strengthen again. We'll kind of watch this one. I don't think it's going to be a huge outperformer, but it could continue this relative uptrend that we've seen. Utilities, like consumer staples, these are two very defensive groups, and they're two very unloved groups right now. You see that PPO, and this is a perfect example. Sometimes what happens when you get a PPO that crosses the trigger line under the 0 line. What this means to me is that the selling momentum is not as severe as it was. That's different than buying momentum picking up. It just means that it's less selling momentum. And look at what's happening here on a relative basis. We bounced a little bit on a relative basis, kind of a dead cat bounce, and then rolled right back over again. And then look at the PPO turning back down beneath the trigger line again. So this signal wasn't really a huge signal. Here, we got a signal and it lasted maybe a month. Here, we got a signal, it really didn't do us any good. By the time the signal came in, we didn't really show any more relative strength before rolling back over again. So anytime you get a cross of a PPO underneath the center line, just remember, it's not necessarily a sign of great buying momentum. What we're seeing with the PPO falling is that selling momentum is increasing. And when you turn back up, many times that all that is just telling you that the selling momentum is slowing. Doesn't mean it's gone away. And so after a period of, short rebound, a lot of times the selling will kick back in again. Same thing happens on the long side, the bullish side. And if I go back here to technology, I mean, here, we move up, we move back down below the trigger line. move up. Here we kind of tested it. Here we moved down below it and then right back up. Every time you cross below it doesn't mean that means you should sell technology. It's telling you that the buying momentum is slowing, but it doesn't necessarily mean that it's on an outright sell. And you can see the whole time the PPO was coming down, all it meant was that the buying momentum slowed. It didn't mean selling momentum took over. I don't get concerned until we see that cross into negative territory. That was temporary. Now we're coming back up. Anyhow, let's move on over to energy and materials real quick, and then we'll wrap this up. Energy has been flat really since March on a relative basis. We had a huge start to the year, really ever since the vaccine news back in November. Had this huge run. We got back essentially to where we were in June on a relative basis, pulled back, putting in this right shoulder, haven't been able to get this breakout. So I'm looking at a relative reversing head and shoulder pattern, left shoulder, neckline, head, right side of the neckline, right shoulder. Now we're just sitting out here. I think in order for this to break out, we're going to need to see crude oil prices get through $77 and maybe even need the dollar to roll back over, but definitely need to get energy prices, the crude oil prices through 77. Now, materials is the one that I think has really changed character. This was a group that was leading for about 15 months, pretty much while the dollar was going down. The dollar's been strengthening last couple of months, and you can see what's going on now with materials rolling back over. I just, we're still in an overall uptrend. Maybe keep an eye on the recent price low around $80 on the XLB. Wouldn't want to lose that, but you can see relative strength has now moved below both moving averages, and this relative PPO is making a mad dash toward negative territory. So all of this tells me you want to be a little careful. All right, looking at the industry groups. Now, what I did here, if you go back and look at the 10-year Treasury yield, you can see over the last month is when we've seen most of the decline in the 10-year Treasury yield. So I thought what I would do is just pull up the relative strength of industry groups and use the period 1 month. So what groups have been outperforming over the last month, given this drop in Treasury yields? And that's the way I like to analyze the market. I like to see, okay, what happened in the market? What's been going on? Well, one of the big stories clearly is Treasury yields dropping from 160 to 130. During this period, many of the higher growth areas have performed well. Many of the areas that did well during the pandemic have come back. Footwear, broadline retail, renewable energy, which was the best performer last year during COVID and that whole pandemic throughout most of 2020, renewable energy was the leader along with autos. Well, here you can see renewable energy. Down here you can see autos. So they're both on the leaderboard. But then you've got computer hardware coming back, software, medical equipment, specialty finance, internet stocks, biotech, specialty retail. Where have they been? They've been lost for a while. They're coming back. Financial administration coming back. Specialized consumer services, apparel retailers. These are all areas that should benefit from lower interest rates and more growth. So it's just interesting how that's all flipped. If we go to the bottom of what's not been working, some of the areas that were working are no longer. And you can look at the non-ferrous metals. Remember, that was a group that had been very, very strong. Look at the relative underperformance here now over the past month. So there's materials, here's materials, here's materials, materials. I've got all these set up where you can see the sector that they're in. So 4 of the top 15 or so are in the materials group. Consumer staples, energy, industrials. Here we go with financials. Here's your banks in the financial area. Life insurance in the financial area. Those are 2 key areas when interest rates are going down, you don't want to be in. When they're going up, you definitely want to be in. So thought it would be interesting just to point all of that out. Let's move on to earnings spotlight. So here's a company Smart Global Holdings that reported its earnings. I think they came out yesterday after the close. They beat. It was actually a pretty good report. $1.39 versus $1.10. Stock had been a pretty strong performer through the early part of April, and then pulled back, put in a double bottom, and we've just been going sideways. The stock's up more than 6% in pre-market last time I looked. So that would be up somewhere around, I don't know, $2.70, something like that, $2.70, probably over $50. So it looks like we're probably going to take out these recent highs and perhaps make a run toward that 57.50 area. This is in the semiconductor area, by the way. So not one of the big names in semiconductors, but still, it's good to see semiconductors, even the smaller ones. And I think this is maybe a $1.2 billion company, something like that. But it's nice to see semiconductors coming out with a nice report here. Another company that reported, MSM, I think they reported this morning, MSC Industrial Direct. And this had been a leader through May, had pulled back a little bit. They did beat $1.42 versus $1.37, and the stock was up about 1.3% pre-market, so a little over $1, which would take it up to maybe about the 92 area, getting close to that 50-day moving average, which is sitting right at 92. We'll see whether or not we can get back through. I would say right now, I would treat this as just sideways consolidation with maybe 86, 86.5 as the lower area of support, and maybe around 96, 96.5 would be that resistance area to watch. The last thing I wanted to do with earnings was just do maybe a quick little RRG chart. And what I did is I threw companies on here, not the banks. You know, they'll be reporting next week. I did an RRG with the banks not too long ago. So I took many of the banks, the energy companies, things like that off. And I just looked at some of the healthcare, technology, and consumer discretionary names that will be reporting here over the next few weeks, or excuse me, over the next, I don't know, maybe next week or so, probably the end of next week, by the end of next week, and thought I would put them on a chart. Now, if I hit this center button, you can get a better sense of where everything is. But here's Twitter. Here's Chipotle, CMG. If you haven't looked at that chart, tell you what, it's been making a big move. SWKS, which I've talked about recently, Skyworks, making a nice move. Netflix has moved into the leading quadrant on a daily chart. So Netflix starting to show some strength. ISRG has been going kind of down in momentum, but still quite a ways over on the right-hand side of the leading. And then you've got Edwards Life Sciences, which is turning from leading into weakening, but I would be looking maybe for a turn back to the upside. And then a couple of the semiconductors, a couple of the larger names that'll be reporting next week, Texas Instruments and Intel, both on the left side of the chart, showing negative relative strength versus the S&P 500 on a daily basis. Now, what you can do here is, I'm going to do this now, do the max. But if you go back and you just take a look here over the last 3 months, you can kind of see, now this is as we're heading toward earnings. I want you to focus on Chipotle, because I think they're going to come out with a big report. Just watch what this chart has been doing, or how it's been performing relative to the S&P. And I'm going to lengthen these tails to 2 weeks, 10 days. So it's really weakening, really weakening. This is as of May 20th. And remember, there was a lot of concern about inflation back during May. Now, all of a sudden, yields start dropping. Inflation's not a big concern. And look at what Chipotle has done. It's worked its way all the way from the lagging into the improving, and then now into leading. And if you want to look at what that chart looks like, let me pull it up. CMG. You know, it's been sideways consolidating after a long run to the upside, but this double top, we're now testing that as we get ready to go into earnings next week. Now, I think a pullback would be an opportunity to the 20 days. So if we fail to get through resistance and we pull back, I think that would be an opportunity if you're okay holding into an earnings report. Generally, I don't do that. I normally would just be looking for the bounce off of the 20, and then I'd get out. If I really felt strongly, maybe I'd hold on to a piece of it, but I normally won't hold a full position just because of the risk. It's great when you hit them and they come through with the big number, but man, does it really, it stinks when you're in a stock and you've made money on it, you hold through earnings, and then all your profit evaporates. Next thing you know, you got a losing position. Then you're trying to figure out, well, now what do I do? Do I get out with a big gap down? So that's always a tough decision to make. So CMG, I think, looks good. I mentioned Twitter, also looking good. And I'll show you Edwards Life Sciences, which had moved down into that weakening quadrant. But here's Twitter. So Twitter's looking very good, bouncing off the 20-day. It's trending higher, and it's moving toward these prior highs. I think we're probably going to test them, especially if that yield remains low. Edwards Life Sciences was very strong, and on a daily chart, it's weakened a little bit on a relative basis, but you can kind of see it still has broken out. And today's action, up another 74 cents, but it's trending. It's broken to new highs. It's trending above its 20-day. And that's what you're going to see when these daily RRGs move over to that right side of the chart. You're generally going to have some pretty good looking short-term charts for sure. All right, last thing I wanted to do was just go through and pull up the three you must see. So I thought I'd start with the PANW. This is Palo Alto Networks. Lots of sideways consolidation. We finally broke above these recent highs, and we're trending up off of that 20-day, which I like. Volume trends have turned up really nicely. PPO looks good. We now are staring down this $400 resistance level from February. I think we're going to break out, but we may have to pause there. We'll see. EVBG in the software space. This is Everbridge. Notice right now we're breaking back up above these reaction highs. I think this is very bullish as we get more and more folks moving into higher growth areas. You're going to see more and more stocks like EVBG breaking out above key resistance levels. I think that's what we're seeing here today. And then finally, Amazon. Got to bring up Amazon. Huge breakout yesterday. I mean, this was major because we've had so many tests up around this 3550 to 3600 area. And yesterday, I love that big hollow candle with heavy volume to confirm this breakout. Doesn't mean we won't pull back. I think, probably the 20-day EMA is the lowest I think we will see Amazon go. I don't know if we go back there. I'm just saying if we do go through a period of weakness, that's probably the lowest. I would think your reward to risk would really be solid as you get closer to that level. From a price perspective, I think price support right here at 35.50, that's where we broke out from. So you've got that. Now, after gapping up today, you got a little bit of gap support at yesterday's close, which I think was around 36.79 or 76, something like that. Anyway, Amazon, I think, looks really good. So let's take a look at the overall market, see what's going on here at the open. Dow Jones up 1 point, S&P up 7 points. Right now, it's all about the NASDAQ, up 62 points. So on a relative basis, performing well. We do have small caps and mid caps up today, so that's nice to see after movement to the downside. And the VIX has fallen back. VIX was up quite a bit yesterday, but we are seeing that pull back a little bit. So off to a pretty good start this morning. We'll see what happens. Keep in mind, and I've written about it, go back to my Chart Watchers article, dealing with I think the title of the article was something, what Wall Street doesn't want you to know about S&P 500 performance, something like that. Anyhow, in that article, I talk about pre-earnings advances and how powerful these tend to be. And we're right in the middle of one right now until probably the middle or latter part of next week, probably latter part of next week. So, yeah, I think right now we're in a sweet spot for the market. Interest rates going down favor growth stocks. And so that's what I would continue to look for here in the short term. 10-year treasury yield reverses, and then we got a whole new ball game. And unfortunately, that's the world we live in right now. It's been a rough year in terms of trying to keep track of the rotation. Not whether the stock market's going to go higher. I believe it's going to continue to go higher with, your minor corrections and pullbacks along the way. I think the overall trend, though, is clearly higher, but what's going to lead? That remains the question, and it will continue to be the question into the second half of the year. Everybody have a great day. I'll be back tomorrow for the next recorded version of Trading Places Live over at Stock Charts TV. That'll begin at 9 a.m. tomorrow morning. You can just go over to stockcharts.com, click on the SCTV right here, Stock Charts TV link at 9 a.m. And you'll be able to click and listen to my recorded show. Be back here at Earnings Beats for your next live Trading Places live show next Monday morning at 9 a.m. Everybody have a great rest of your day. Hopefully see you tomorrow. Take care. Happy trading.